What's up, you guys? It's Lincoln here. I just wanted to make a quick video about why you should be using IRAs and 401ks and other tax efficient accounts instead of just using an individual brokerage account. This is my biggest beef with Robinhood. I really like their user interface, and I don't think they're doing everything totally bad, but they do not offer IRAs, Roth, traditional. Obviously, they're not doing 401ks, any of that, and that is my biggest issue with them. I think you guys should be using tax efficient accounts, which is exactly what I do. You guys have seen my account. It is primarily in a Roth IRA, but I also have quite a bit in traditional, and very, very little money is actually in an individual brokerage account. So obviously that's what I'm doing, so that's what I recommend that you guys do as well. And here is the math behind why. So first of all, I basically have a massive sausage fest on my channel. It's a bunch of dudes, mostly in that, I guess, 20 to 35-year-old range, I think. I'll put up the picture here. So I wanted to jump into why you should be using these tax-efficient accounts and how big of a difference it can make, as well as kind of talking about why it's so important to make contributions when you're still young as possible, and basically max them out as young as possible, and just how powerful compound interest is. So yeah, here is a spreadsheet. I'll link this down in the description. It's my same spreadsheet as before. I just added this. And then I also added a covered call tracker page. I'm going to talk about this in next week's video, so you guys will want to be sticking around for that. But we are going to be looking at this balance projector tab. I didn't know what else to call it. So this basically says, here's your beginning balance. Also, these are all formulas, so all you need to do is change these three and it changes everything else. So your beginning balance column, your amount added per year, your return, and then your ending balance. So there is all that, and then obviously you can see the years here, 0 through year 30. I did 30 years because most of you are in that range. It could be 30 to 40 years. I'll just do 35 actually, to make this more round. Okay, so going out 35 years, and right now I just say we're doing $6,000 a year, as that is the contribution limit for IRAs. Obviously, if you bump this up, it's going to have a bigger impact on your ending balance, but this should give you a basic idea of how much money you can plan on retiring with based on a certain return percentage and an amount added per year, and obviously your beginning balance. So first of all, let's jump into compounding. Well, I guess we'll back up. How much money do you need to retire? Most of the time, the amount getting thrown around is 4% rule. So if you have $1.65 million in your account when you retire, you can basically plan on living on about $66,000 a year, which is enough for most people. That's not a lavish lifestyle, but it is nothing to scoff at either. So that is the 4% rule, so you can kind of use that to project. This is a fairly conservative rule. It doesn't take into account Social Security, which may or may not still be a thing by the time we reach the age where we could actually use it. And it does not include, it does include inflation and a couple other things. So this is a pretty conservative number. But it is a good one to plan based on. Okay, so there is that, and so now let's look into what compounding does. So say you decide, oh, Lincoln, I don't have the money to invest right now. I'll start when I'm 45. I'll have more money. I'll be making a higher income then, and I'll be able to contribute more to my retirement. So let's say instead of contributing for a full 35 years, you're going to contribute for the second 25 years. The back half, obviously more than half, but the back 25 years. So let's take a look at this balance. So right now it's $1.65 million. If we take out the first 10 years, that number drops to less than $1 million, okay? So you have $60,000 in contribution that is adding about $700,000 to your net worth after the 35 years. So let's add this back in and see 1.65 million. Now let's do the other side of it, okay? So let's say you scratch and you claw for every dollar that you make, and you're able to put aside $6,000 for the first 10 years, and then something crazy happens and you decide, I'm not going to add anything else to my account for the next 25 years before retirement. So $1.65 million is what we're looking at. You still have $1.2 million. Okay, I'm going to share this spreadsheet. You guys can play around with it. You can look at the math, but this is the powerful, powerful math behind compound interest. So you are down just about little over $400,000 when you take out these 25,000. Let's look at that. So that's $150,000 worth of contributions, and you only miss out on $400,000, just over $400,000 to your total net worth at the end. So you can see what this is doing to your annual, basically how much you're going to be able to spend when you do retire. So I'm basically just showing you this exercise to show how important it is to get these early contributions in. It is absolutely paramount. I bet, okay, so if we get just those first 5, okay, you do, I guess this is 6 years. If you do 6 years of contributions, you're at just under $1 million, which is the same number as if you contribute for the last 25 years, okay? So we did this earlier. It is basically the same number, okay? So you can contribute for the next 5 or 6 years, or you can contribute for the 25 years after that, and you're going to end up with the same balance, okay? So that is compound interest. Feel free to play around with this. You've all heard it, I'm sure, before, how important compound interest is, but here is the math behind it, and I hope you guys realize that and can play around with it. And yeah, I think Warren Buffett said the best time to start investing is 10 years ago. The second best time is today. So, like I said, you might not have 35 years until retirement. I understand that. It sucks. You missed out on some compound interest, but the best thing you can do is start today and do whatever you can to make your contributions. It has a absolutely massive impact on the lifestyle you're going to be able to live when you retire, if you're going to be able to retire at all. Okay, so now let's talk about tax efficient strategies. So for the most part, you can do a traditional IRA or 401k. Those two behave very similarly. They have different limits for contributions. You guys can look those up. They're very easy to look up. Just look up 2021 IRA contribution limits. Okay, so it's $6,000, and then you can do $1,000 extra catch-up if you're 50 and older. Or if you want to look up 401k contributions, it's $19,500. Okay, so you have those different limits, but I don't want to get into the details. I'll make another video about this in the future. Traditional IRAs and 401ks behave very similarly. You put in pre-tax income. It's basically a tax write-off. You guys might be running into that right now as you're doing your taxes. There are tax write-offs. You could contribute pre-tax dollars, and the money that grows is tax-free. And then for traditional and 401ks, I think there are RMDs on 401ks, so you might want to double check me on that. I guess I can Google it real quick. Are there required minimum distributions for 401k? I'm guessing so. Anyway, yeah, you guys can look into this. I'm pretty sure there are for 401ks. There are for traditional IRAs. There are not required minimum distributions for Roth IRAs. Okay, so look into this stuff. This isn't really what this video is about. Like I said, I'll go over in a more detailed video about those specific things. But right now, I'm going to explain why it is so important to be using either a traditional or a 401k or a Roth IRA. So okay, so all these numbers, these are based on an 8% annual return. This is also something you guys can play with. Say you bump this up to 10% return. This absolutely balloons the number. Okay, so you get an additional $1.2 million if you can crank those returns up a little. So play around with this, have some fun, see what it does. Anyway, so let's say instead of this 8% return, you decided that you were going to only use your Robinhood account, your individual brokerage account. Okay, so let's say your income tax rate is 20% on average. Okay, so instead of getting an 8% return, you're going to get equals 8 times 0.8. Okay. Okay, so instead of getting an 8% return, you're going to get 80% of an 8% return, which is obviously 6%, but because you're paying 20% per year in taxes, so there goes $600,000. Okay? So let's say you're in an even higher tax bracket, say you're paying 25% on your income tax. Now you're down to $980,000. Okay? So, like I'm saying, play around with this. You want to be using tax efficient strategies. Obviously, using IRA accounts, they are tailored for people to be using them in their retirement age. So there are penalties for withdrawing money early, which you don't have in an individual account. I could talk for a long time about this issue. Basically, no, you shouldn't be investing money that you're planning on needing to use in the next 5 years anyway. Like with the market can tank. You don't want to be forced to take money out at the bottom because you need to make car loan payments. Okay, so do not be investing money that you need to touch. If you're going to use, if you know you're going to need to spend $5,000 in the next 2 years or the next 5 years, then you should have $5,000 set aside in a money market account or CDs or just in your bank account. Whatever, okay? I'm not talking about that right now. I'm just talking about the math behind why you should be using tax-efficient accounts, okay? So I'm going to link this sheet down in the description, so please play around with it. Like I said, this is my biggest beef with Robinhood. You can only use individual brokerage accounts, and over the long run, taxes will have a massive impact on your ending balance. And if you guys want to know what I do, I'm mixing between traditional IRA contributions and Roth contributions. You can just Google why I'm doing this. Basically, I'm not even going to get into that in this video. This is all about the math behind this, and please check this out. Like I said, has a massive impact on where you're going to end up over the course of 35 years. So let me know down in the comments if you have any questions. I think next week's video is going to be about selling covered calls based on our Deep in the Money leaps. So you guys are not going to want to miss that, as that is pretty crazy. If you want a spreadsheet to use for that, feel free to use this. And yeah, drop a like if you found this information useful. Feel free to subscribe if you want to see more like it. And I'll catch you guys in the next video.